Ron here from the hit podcast, The Other Side of Wall Street. And if you're like most of us here in the trading community, you no doubt have mentors or experts that you look up to for trading advice and knowledge. Well, how many times have you wished you could just sit down with one of those experts and have a good old one-on-one conversation with no script, no planned questions, just a friendly chat? Well, that's what we're bringing to you here. Each week, we'll visit with a different expert and have an up-close and personal conversation about anything and everything involving trading. So sit back and enjoy as we get to know our special guest. Good morning, everyone. Welcome to Market Masters, brought to you by the Other Side of Wall Street. My name is Ron Harrison, and I'm here today with Serge Berger. Thanks for being on, Serge. And for those of you who are not familiar with him, Serge has been an active trader since 1998. And during his career, he's been a financial analyst in fixed income instruments at JP Morgan and was a proprietary trader in equities, equity options, and futures. And having had exposure to a range of different asset classes allowed him to identify which asset classes and strategies best fit his goal of achieving consistent profits. So welcome. Looking forward to talking to you, Serge. And thanks for being on.
Thank you, Ron. It's good to be here.
Good. Now, as I always do with people that are on the show, I tend to do as much research as I can on them before they come on, so at least I know what their background is and what they like to talk about. With you, man, your videos go on forever. I mean, you must have thousands of them up there to watch as far as doing research. I mean, you're a busy guy. But one thing I noticed, there seems to be in a lot of those, of course, there's so many of them, I can't really make a big claim here, but through a lot of those, you talk about things that, in my opinion, are related to trading psychology, to what goes on in the trader's mind. For instance, I mean, you have a lot of them on here. Let's see. Well, the first one that pops up is trading on vacation, which is still going to be a mental thing. Trading versus gambling, minimizing your risk, successful trader's mindset, a lot of those things. So I would assume, based on the amount of years you've been in this business and the amount of people you've dealt with, has it been your finding as well as mine that psychology kind of is the downfall of most beginning traders?
Yeah, for sure. I mean, I think you're hitting it right on the head. I mean, I would say, the psychology, but really you can extend that over into emotions, fear, and greed,
and ego. I go three: fear, greed, and ego.
Yeah, it is the one and the same thing. And I think that we live in a world of immediate gratification. Mm-hmm. And it somehow is amazing to me that no one would expect to go to the gym having never lifted weights and, looking like Arnold with two bicep curls. But for some reason in this business, they think open a broker account, hit a few buttons and make money. And then you couldn't be any further from the truth, right?
But the books kind of lead you in that direction. They make it sound too simple,
I agree. That's the marketing problem that this industry has.
And I know even in my case, like I told you before we started, I used to work on Wall Street, and I felt I knew everything there was to know. So why am I doing this for them when I can do it for myself? So I left there, set my, like what you have there, it looks like, set my thing up at home, started trading. Everything was fine. And within a few months, it was total disaster. I mean, everything that worked while I was there totally fell apart when I started doing it for myself. And I didn't know why, but eventually I realized one simple thing. Now I'm trading my own money. Before I was trading somebody else's. So the whole fear and greed thing never kicked in there. They were just following the rules. But once you start doing your own money, strange.
Yeah, it's a different game. And like when you I'm at my home in my Florida home, but I think what's important, I've got two offices, and it's because also we manage money and everything, so you have to have real offices. But I think it's a lot of people have a difficult time trying to take it serious when they're at home. This is just my home office, right, which I'm hardly ever here. But I think for a lot of people, just because they're home, they feel like it's more of a game than something serious. That's a whole nother psychological thing, right? But I think for the most part, it's really just that they can't imagine how difficult it is, especially, because it seems so easy looking at a few charts, and if you would have bought here and sold here, right? But it's much more difficult.
I think most beginners structure their trading strategy on hindsight.
Oh, 100%.
Yeah, yeah.
No doubt. Yeah.
Not just that too. I find that because of how we were raised, our parents would always say, the more you work, the better you're going to do. Work 8 hours a day, 10 hours a day, 12 hours a day. The more you put in, the more you're going to get. So they open their brokerage account, sit down in front of the computer, and think they got to trade. Every hour the market's open, and that's a dangerous.
Yeah, it's and it's really funny because if you look at some of the most successful traders and investors that I know, I mean, they work hard, but it's mostly research and reading and not hitting buttons on the computer screen. But I think it's people's desire to make it as simple and as easy as possible leads them to just look at a few charts as opposed to being willing to learn economic cycles and interest rates, which is everything, right? And if you're not willing to learn that, then it's very difficult. I think a lot of people never even get to the point where they understand that psychology is really what's keeping them from making money.
Absolutely. I also know that you're a big advocate of selling options, income producing strategies. Where along your career did you realize that there was another side to this market? Like, everything doesn't have to be bought. You can actually, you don't have to be the gambler in Vegas. You can be the house.
Yeah. No, for sure. It's interesting. I was, I had learned, I started trading in high school when I was playing golf with some wealthy traders. I didn't know what they were doing, and they kind of introduced me to it because they were trading from their golf carts. And then I went to college, and I did the whole, I went to college through the right into and through the internet bubble in the late 90s, early 2000s. And but then I started to work on Wall Street, and one of the things that I did is I was trading in credit default swaps, which is a credit instrument. And so, one of the things you would do there is you'd either buy or sell what's called protection. And it just intrigued me that even though ultimately it blew up in people's faces, if you were a seller of protection, you were just making so much more consistent money. And now you can't compare options to credit default swaps in that sense. But from a perspective of selling insurance, that really resonated with me, and over the years started doing that. Then when I moved on from there, went to family office and things like that, where that became the prominent thing. And it just proved to me that the goal of it all is really to become the casino and not the gambler. And I think that's the only way to actually do that.
But like you said earlier, people seem to look at that on a surface level and say, say for instance, if you got a $5 spread, and you collect 50-cent premium, you're risking $4.50 to get 50 cents. But
correct. But are you, right? If you do it correctly, and I don't know if you want to get into that later, but if you do it correctly, you're not, right? So it's one of those things.
No, I agree. What's your, as far as selling option strategies, what's your favorite, what's your go-to strategy?
For the most part, I like to be a spread seller, and it doesn't matter whether that's an ETF or an equity, or we'll do it in other things as well. But that's kind of the predominant go-to, and the approach that we have is really more of a top-down approach, where yes, of course, ultimately you'll look at a chart, but it's to me it's important that we're in sync with what's going on in a bigger picture sense. Meaning that we know, what's currently important moving the market, what are global assets doing, what are, interest rates really being the predominant thing, which kind of is determinant of everything, and inflation and growth, right? And those things, and those sort of, quarterly or monthly kind of views. But then based on that, then we'll look for sector and group rotation, and then based on that, there will be a seller of far out of the money call or put spreads. So making bullish bets, we'd sell far out of the money put spreads, and vice versa. If bearish bets, sell far out of the money call spreads. We'll do it in a very specific way. And I'm happy to talk about that, but that's the basic idea, just to make sure, you have a chance of making money, whether the stock goes sideways, up if you make a bullish bet, or even against you, and you can still make money, whereas you can't do that if you buy a stock. It has to go higher.
Exactly. No, and one of my questions was if you want to talk about the benefits, but I think you've kind of covered some of those already of selling options. Do you sell just on equities, or do you venture as far as selling options? Do you go, currencies, futures, anything like that, or you stick with equities more?
Yeah, it's largely concentrated on equities and ETFs in that world, but we'll definitely do it on futures as well, and in some occasions we'll go into currencies. But we found that we can pretty well cover the universe, both on the advisory side through the lens of newsletters, and on the asset management side at the registered investment advisor that we have. We can pretty much cover the world largely with ETFs, and you can do that ETFs in Europe as well. So it works rather well. You can make that bit a lot more complicated than it needs to be.
Do you provide service for your clients as far as what to buy, or do you teach them how to do it and let them figure out what they want to do?
So what I require on that part of the business is I require people to be willing to learn. And so what we'll do is they will purchase a little course, maybe an indicator, and then once they've proven to us that they're willing to learn and they attend a bunch of webinars that we do for them, then we might allow them to become part of what the industry calls trade alert services. I don't like that term too much, but we will actually send them trade alerts or trade ideas in an actionable manner. But I don't believe in doing that unless you found a group of people that are willing to learn, because
Right.
otherwise they can't conceptualize it.
Right. And of the mass of people that have gone through this program with you, what would you say is the leading reason why they fail when they fail? Or what's the biggest problem you see with those people?
Yeah. Two things. Number one is unrealistic expectations in terms of, some people come in, they have an account of $2,000 and they think they're able to make $2,000 a month. Unrealistic expectation. And the extrapolation of that really would be unrealistic expectation in terms of how quickly they can learn it. And that's exactly why we make sure people first get some education tool where we teach them, it's not just they watch a video course, we'll actually do webinars and everything for them as well. But they have to be willing to learn. And I think a lot of times people just are almost desperate for money when they come into this business. And that is the worst. I don't know how you feel about that, but to me, that's the absolute worst spot to be in if you want to try to make money from the markets.
When you're trying to make it because you have to make it. Yeah, and I've had clients that will take classes, they'll quit their job, decide they're going to trade for a living, and have all this pressure because they have to make a certain amount every month to pay the bills.
Yep.
So now they're trading and they have to make X dollars every month, so they have to think they're going to do whatever they got to do to make that. And I tell them, the market's not going to give you what it's going to give you. You can't make it give you X number of dollars. It doesn't work that way.
No. I mean, I'm sure when you said you were working on Wall Street, I mean, when you quit your job in that sense, you end up getting into that spot inevitably to some extent, and I have a story on that as well, where I got into that a little bit, but I also started the money management company at the same time, so it kind of managed to buffer it. But I think it's to some extent, and to be fair for people who kind of take it to the extreme on that, like the example you just gave, it is to some extent inevitable that you have to do that because you do kind of have to ultimately, even if you kind of take that jump into the cold water. Mm-hmm. But I think a lot of people do it too much, kind of like the example you gave.
And all of that is nothing but fuel for the fire for the emotions.
Yeah.
The more pressure you put on yourself, the more you have to make, and the fear and the greed and everything kicks in. I had a guy on here, I don't know if you've heard of Randy Howell. He's a trading psychologist.
Okay.
And one of his things was less is more. In other words, a lot of times if the trader will try to trade, instead of trying to hit home runs every time, back off, trade smaller, have lower goals, just trade for less, and allow the power of compounding to do the heavy lifting for you, as opposed to trying to make everything in one trade or two trades or 1 week. Slow down, let it compound.
Yeah, no, for sure. I think in this, that's interesting you mentioned that. I had a discussion with one of my employees on that today for one of the services that we run. and because we had a couple clients had asked some really interesting questions, and I think that's a valid point. However, it depends on the market environment. So like right now everything's going straight up, and it looks like it's never going to go back down again. And so that's fine. You can wait and kind of let that compound for you. But it doesn't work when things get more volatile, because one day you're here, next day you're here. So then you have to be more. So what I found to kind of bridge both of those kind of worlds is to just be a little bit more active, like take small gains. Not only does it, at least to some extent, likely build your accounts, but it'll give you that positive feedback loop that you need to see that you actually can make money, right? Because a lot of people, what they do, and I'm curious what you think about this, but what we found is a lot of people on retail side do, they have, trade 1 is a winner, trade 2 is a winner, trade 3 is a winner, trade 4, trade 5, and then they come to trade 6, and they lose about 80% of what they made on these first 5 trades.
Because all along, each time they have a winning trade, they get more and more confident or overconfident. So they keep increasing their risk or their trade size until they
exactly. And so that one wham is such a big problem, from not only financially, because now you're almost back to square one. It's psychologically, it's a massive damage.
Yeah.
And so what I found is that in order to get, because everyone's going to do this at least 50 times, it's just how it is. But in order to get out of those big drawdown periods, not just financially, but psychologically, again, I found to do smaller trades, do them quicker, take a quick profit, even if the stock ends up running wherever it wants to go in your direction. It doesn't matter. At least you took a profit, and you start to see some green on your screen, which again, it's a psychological thing.
And don't keep increasing your risk size.
No.
Yeah. Yeah.
No,
Right.
in fact, you could make the argument of starting off larger and then continuously decreasing it, which,
Which is a good theory anyway, because actually, even if with the market that's doing well, like this one here, the longer it goes, the more likely it's not going to go. So
yeah, I mean,
overconfident at the end, you should be getting more and more cautious as time goes, and start shrinking.
Speaking of this market, it is quite something that we're seeing, and I think a lot of people tend to forget, and you see this every year, every time you see that this is an extreme move now, but you see people get so comfortable and they forget that what markets that go parabolic, they don't correct in orderly manners. They correct very sharply. Doesn't have to be end of the world, but if almost any stock, let's say a stock has rallied 20% of the past few weeks, almost everything has, for them to correct 10% is not a big deal.
I saw your video that you put out, I think today, for your bonds.
Okay. Yep.
So you're saying yields might be falling, or so I would. What am I assuming right that you're saying that if bond prices go up, that means market's going down?
Potentially, I think it's an interesting conversation. So, there's having originally come from the fixed income side, I look at the world through that lens primarily, and then kind of extrapolate where to go, which has helped me over time, because the fixed income market do kind of dictate everything else. Unless the Fed kind of, rig. I don't want to use the word rig, but kind of extends more economic cycles a little bit unnaturally. Is what it is. We need to respect that as a market participant. But yeah, I think what's happening right now. I don't know how timely you want to make this, but it's.
Oh, sure.
Okay. I think we're in just very late cycle, and I think the equity market is to some extent whistling past the graveyard. Again, it's in large part, kind of Fed-induced stimulus, but the bond markets are telling you something very different.
Mm-hmm.
If you look at benchmark 10-year bond yields, it wasn't that long ago when they were 3.2% in October 2018. And everyone thought they were going to go to 4%. And I remember making YouTube videos. I'm sure you can find them probably. And I was saying, listen, I think they're going to probably go closer to 2%. And the emails that we received on that were not very pleasant. Right. So it's not necessarily a call that the equity market has to fall apart. In fact, you could make an argument that if bond yields go, let's say 10 yields go towards and maybe below 1%, at least for now, you could make the argument that equities could hold a bid but they're not going to hold parabolic moves like we have right now. I don't think that's possible.
I know. I keep looking at these charts every day, and I keep thinking, why? I mean, it's just
Yeah.
even nowadays. I mean, nothing can scare this market. You know, we have the thing out of China. You know, with the virus, and it used to be that would kill markets. Nothing.
No, and it's really interesting. I mean, you can, and there are, you know, or there's always, you know, an argument you made for either view. But I think it's a little bit difficult to argue that this latest move isn't Fed induced, and then ultimately, of course, it feeds into algorithms, and then the retail community and everyone just is like, you know, whatever, Tesla's going to go to 1,000 by tomorrow. So I think we, even us, and who've seen this 1,000 times, at some point we're just like, there's no rationalism for it at all.
Funny thing is, though, about a year ago when I was looking at the markets, I was saying the same thing, and it's done nothing but keep going since then.
Yeah, yeah. Well, I hear you. I think now we're seeing a different level of craziness.
Yeah, no, I totally agree. Yeah. Am I correct in assuming you have a proprietary software program that you designed? You're one where you divide things into sectors and.
Yeah. So what we do is we really look at the market through the lens of, again, it's a top-down approach, but ultimately we look through sector and group rotation because, again, and you know, this would be a great conversation to have. The dog wags the tail, meaning, you know, what a lot of people do, and if you go through the sort of the circus that is stock market in trading out there, you find a lot of stuff where people have paid no attention whatsoever to a sector or group that any given stock, let's say, belongs to, which is completely lopsided because at the end of the day, it's the sector and group that determines what the stock does. I mean, of course, some stocks will lead, right, and some will lag, but you need that confirmation. Otherwise, if you don't trade with the trend of the sector and group, you have, by definition, about a 20, maybe 30% chance of making money. And so, yeah, so we put that in the software and we make it very simple for people to literally click on the sector and then they find the stocks that are doing what the sector is doing and so on and so forth.
And is this software that you guys sell, or is it something that only you guys use and then you use the information for your clients?
Yeah, well, initially we built it just for a couple of the larger family office clients that we have, but we've since seeing how much people liked it because we showed it in webinars and stuff. So we've since made it available to, it's a very much cornerstone of any of the research products that we have to make sure people use the process. It just, you know, I think a tool is always easier to explain something with. Like I always give the example, if you watch the Golf Channel, you know, and let's say the first commercial is the 8-step golf swing DVD by Jim McLean. And the next commercial is this magical unicorn driver that makes you hit it down the road, down the fairway. What are people going to buy? Right? They want the tool.
Yeah. I was there and I did.
Yeah, and me too. You know? and
they just sit in my bag. I don't even use them. But I have to have them at the moment.
That's good marketing.
Yeah.